All right, good afternoon or good morning, everyone. We're here today to talk about health savings accounts and how important they are from a tax perspective. And today we have Julia Fuentes from Vanguard, who is part of their client education team, and she is a HSA expert and will be walking us through not only the tax benefits, but also how to set up HSAs, how they work over the long term, and the recent changes to the One Big Beautiful Bill, how those also impact HSAs going forward. Uh, Julia, thank you for being with us today. If anyone has any questions during the call today, please put them into the chat or the Q&A, and I will ask them of Julia while we go through this. Julia, turn it over to you.
Thank you so much. And thanks everybody for joining us today. We are going to walk through what an HSA is and talk about if you could qualify to invest in this investment vehicle. We're going to go through some of those benefits and different use cases to get you more comfortable with why you might want to think about this as one of your investment choices. So, health savings accounts have been around since 2003. So, in my head, I'm like, oh, they're relatively new. And then some people look at me and say, that's not new. That's over 20 years, but, still a little bit newer. But in order to qualify to invest in a health savings account, you have to have a high deductible health plan. So we're here entering into open enrollment for those of you that are employed, signing up for your benefits. You might have some choices. Hey, a high deductible health plan or just a standard PPO plan. Well, if you choose that standard PPO plan and it's not high deductible, this HSA would not be an option for you. So that's an important thing to understand. So over in this chart, this is showing in 2025 what qualifies to be a high deductible health plan. The minimum deductible that it must be for somebody that is self only or you have a family plan, and then your maximum out of pocket cost. So you are always protected from those max out of pocket. Well, if you choose the high deductible health plan, you are able to open up an investment account called a health savings account. So for people that have a single plan, hey, my health plan only covers myself, you can contribute up to $4,300 a year. If you are 55 or older, you get an additional $1,000 catch up. I do want to stress the catch up contributions for an HSA are a little bit different from some of our other investment accounts that catch up start at 50. This one, it starts at 55. If you have a family plan, $8,550 that you can contribute into your HSA and an additional $1,000 for people 55 or older as the catch up. So your employer may choose to be nice and give you some additional contributions into your health savings account. Hey, you opt into this high deductible health plan, we're going to give you $1,000 into your HSA. That will count towards your limits here for a contribution. So what your employer puts in does count. You can use your HSA dollars for qualified medical expenses. There is this big list. I actually have a little source at the bottom of this slide, which we certainly can share these with you, where it lists out everything that's qualified. They do from time to time add to the list. But pretty much, if you say, wow, this family deductible, this is a lot for me, $3,300, you can use your HSA dollars to pay for that deductible. You can use it for your out of pocket costs. You might use it for dental, vision, prescription drugs, long list of things you can use it for. Now, you're going to notice that HSAs have been starting to get more and more popular. We're even seeing some firms, they're offering healthcare coverage to employees and they're only offering a high deductible health plan. You don't have the option for the PPO. We're starting to see people see the benefits of health savings accounts. We're going to talk in a bit about how they are triple tax advantaged. So these are growing, and you're going to start seeing a lot more of this pop up. If you haven't seen this as an option in the past, you probably will in the near future. We're seeing more people enroll in them, and we are seeing less of those PPO plans being offered. And the reason being is there's not only tax advantages to you as the employee, there are tax advantages to your employer to offer a high deductible health plan. So when we're looking at like just the regular PPO health plan, that probably is what you're most familiar with. You have your premiums, which are a little bit higher, and then some out of pocket costs. Maybe you have some co-pays, some out of pocket costs to get some care. With the high deductible health plan, you tend to have lower monthly premiums. So everybody's plan is a little bit different, but relative to that PPO, the high deductible health plan should cost you less as you pay that. Maybe you're paying it bi-weekly out of your paycheck. Then you're going to have slightly higher out of pocket costs if you go for care because you have to meet your deductible. But then also, if you're spending your HSA or saving, regardless of how you're using your HSA, you will have some tax savings there that doesn't print on our statements. We don't actually see that. It's kind of this hidden thing, our tax bill, but there's real value there. So when we're signing up for our benefits, oftentimes you're going to see FSAs, flexible spending accounts, and HSAs, health savings accounts. A little less common, but things that are out there are HRAs. We'll spend a little bit less time there. With an HRA, a health reimbursement account, your employer owns that account, sets all the rules, and they own the funds. So the employer has full control. So what we have more control over is FSAs and HSAs. So we already talked about for a health savings account, you must have a high deductible health plan in order to invest in an HSA. For an FSA, the flexible spending account, this comes in different iterations. Maybe you have a healthcare flexible spending account. Maybe you have a dependent care flexible spending account. So when it comes to healthcare flexible spending accounts, you are not allowed to have both a healthcare general flexible spending account and an HSA. It's one or the other. So most people will choose the HSA. But you can double dip and have both if your firm offers an HSA and a limited purpose FSA. So a limited purpose FSA, as an example, would be a flexible spending account for dental costs, a flexible spending account for dental and vision. They limit the purpose of it. Then you can use both. So with the difference between the two, flexible spending accounts are meant to spend year over year. So you're going to get a tax advantage. You put money into the FSA, you want to spend it that entire next year. So you kind of have to budget and say, how much am I going to pay for my costs? And you want to use it or you lose it. They do have lower contribution limits for this type of investment account, but hey, this, you will get a tax advantage. You put money into it and you can avoid paying taxes on this. With the HSA, that's for saving. So if you want, you can spend the money, but if we can let it ride and save in the account, you can save it for years to come, get some investment returns on that. And those funds are yours. If you leave your employer, you can take that money with you. So this is great for young professionals that you might switch careers, switch firms over the years. Well, you can take your HSA with you. You don't have to spend it year over year. That's yours and it's portable. Where that flexible spending account, you know, there's a risk there. You leave. If you're going to leave your employer, you want to spend it before you leave. So we're getting towards year end. If you have your FSA, let's make sure we're spending the money in there to get the full advantage. We don't want to lose that. So at Vanguard, we have a health savings account where Vanguard gives us a little money towards that. And then we also have a limited purpose FSA. So, hey, how much am I going to spend for my dental costs this year? Throw that in there to get the tax advantage and use the HSA. Spend this one, save the HSA if we can. With just so I didn't confuse anyone saying, hey, you could, you can only sometimes have this as if it's limited purpose. Keep in mind, if it's like a dependent care flexible spending account, you're obviously allowed to have that to pay your daycare expenses and have that HSA.
Hey, Julia, how does it
Sure.
work when you have spouses that have different insurance plans? Can one participate in an HSA and one in a FSA? Or?
Yes, you can. If you have separate health plans, like, hey, we're going to keep this separate. You have a self-only plan through your employer. They have a self-only plan through their employer. You can make separate decisions. One of you might have an HSA, one of you might have an FSA. Another thing to keep in mind when it comes to health savings accounts, we're going to talk about this in a bit, but you are able to pay qualified expenses for tax dependents. So if somebody's on your tax return as a tax dependent, then you are able to pay for their qualified medical expenses. If your adult child is on your family plan, but they are filing their own tax return. Let's say they're 24 years old and they're filing their own tax return. They're not a dependent anymore. You can fund the family plan for an HSA in your name. And then also you can fund the HSA for your adult child up to the family max in their name. So there are some situations where you can double dip and contribute for yourself, contribute for your adult child.
Even if so they just have to be on the family plan with you.
They would have to be on the family plan with you, but since they're not a tax dependent, hey, my son, something happens and there's $1,000 bill for the medical expensive, I wouldn't be able to use my HSA dollars because he's not a tax dependent, but I could
Mm.
open an HSA in his name and then spend from his HSA for his expenses. It's a way that we see some higher net worth families. They say, hey, there's no earned income requirements to contribute to an HSA. You can put money in the HSA regardless of your earned income. So I'm going to fund mine to the max and I'm going to fund my adult child to the max. We do see a lot of adult children staying on health plans until 26 these days for a lot of various reasons. My son has let me know he's never moving out of my house. I'm sure I'm going to be in that situation. He's like, I will live with you forever in your basement.
Does Vanguard only offer an HSA plan
So
or a high deductible plan?
for us, we do. So we've transitioned and we say, you know what? We're only going to offer the HSA, but Vanguard is so gracious that they will give us about $2,000 into your HSA to say, hey, we're gonna fund this for you. You can spend it on your medical expenses, the high deductible, but you're gonna have much lower premiums. So we have gone in that direction, and we do offer a limited purpose FSA.
What's the single deductible on that plan
So
or
ours,
family deductible, if you know off the
the
top of your head?
yeah. So for ours, it's a little bit higher. It's I think it's around 3750, somewhere around there.
That's
So
not too bad if they're giving you
yeah.
$2,000.
Yeah, it's not bad at all. It's a pretty, and full disclosure, my husband is a police officer and has this like ridiculously amazing benefits. So I'm on a PPO plan. So I'm here
Okay.
free. As I'm here preaching about HSAs, I'm the one like on the PPO plan because it's a free benefit and it's actually really good coverage. So I'm not eligible to contribute to an HSA, but if I was, I would max it out. So as we talk about, we didn't dig into the tax advantages yet, but for what you should know is with health savings accounts, you have a lot of different places that you can save your money and put your next dollar. It would be great if we had unlimited funds to save, but a lot of us have to prioritize, like, where are we going to put our next dollar? And all these different investment vehicles exist, and it's important to understand the tax advantages. Do I pay taxes now? Do I pay it later? Do I pay it never? And that's where an HSA, as it stands today, is the only triple tax advantaged investment vehicles. So you put the money into the HSA without having to pay tax on that. Then the money will grow over time tax free. And if you withdraw the money for qualified medical expenses, which we all have, that will come out without ever paying tax on it. So it's the only investment vehicle today that offers this. So for a Roth, you can put your money into a Roth. Some people may not qualify to contribute directly to a Roth IRA if they have higher income, but a lot of employer plans, I tend to not see many employer plans that aren't offering Roth as an option these days. You can pay the tax bill today, put that after tax money in there. It'll grow tax free. And then when we're retired, we can take the money out tax free and it can grow. And we have a lot of tax flexibility in retirement. Then we have our traditional IRAs and our pre tax employer plans where we can save on taxes today. Let's say we're in a high tax bracket, we can contribute before tax. That money grows tax free with the thought process being, ooh, in the future, maybe I'll be in a much lower tax situation and that's when I'll pay the tax bill in the future. Traditional IRAs, pre-tax employer plans do come with a required minimum distribution that starts later in life at age 73 or at age 75 if you were born in 1960 or later. Then we have our 529s for college savings. These are becoming more and more flexible. They're also for K through 12, but we put after tax dollars in there. So we've already paid tax. It grows tax deferred. And then if we use it for qualified expenses, for education, rolling up to 35,000 over to a Roth IRA. They have a list of qualified expenses. You can get that tax-free benefits, but we've paid taxes up front. Now with taxable accounts, you put our after-tax dollars in it. Every year we have a tax bill, we get that 1099. And when we take the money out, we might have a long-term or a short-term capital gain. So we pay tax in every bucket. So when we look at, hey, we put a dollar in, what's this going to look like in the future in 25 years on an after-tax basis? The HSA tends to yield us the most if we're going to use it for qualified medical expenses. So to dig a little bit more into what we're talking about when we say taxes, because there's a lot of different taxes. Many people will set up their HSA through their employer. So like at Vanguard, we partner with a company called Health Equity. Health Equity does our HSA administration. We, during open enrollment, hey, how much do you want to contribute for each paycheck? And you can set that and try to max that out. Keep in mind, you have until April 15th of that following year to max out your HSA contributions for the prior year. So let's say you get to the end of the year and you're like, well, you know what? I got a year-end bonus. I have a little extra I can put in there. You do have up until the tax filing deadline to max out for that prior year. But when you take the money out of your paycheck, you avoid the Social Security Medicare tax that we pay. They call it FICA taxes. So when you look at your paycheck, you're going to see OASDI. That's what you pay into Social Security. Then you're going to see that Medicare tax that you pay in. When you contribute to an HSA, this is off the table. So that's 7.65%. Then your state, depends on where you live, that could be 0 to 11% that you can save in your state taxes. And then the biggie, your federal tax bill, that you can avoid all the federal tax. You could be close to 50% of tax savings. And I do have to call out, we have two problem states, California and New Jersey, where they do not let you take a state deduction on your HSA, but all the other states, they do.
Is that because they haven't caught up to the tax forms to allow for it, or they just
Yeah, they've
that's
just
part of their
made,
thing?
yeah, it's just part of their thing. You know, our states get to like pass some state specific legislation. And we see this with 529 sometimes where the federal government says, hey, we're going to pass this federal legislation. And then the state will say, well, we'll allow that obviously at the federal level, but at the state tax level, we're not going to consider that qualified and we're going to tax you at the state. So our states are able to do that. But we only have two states that don't take the state deduction. All the other ones you would save on any state tax. And some states have no state tax. So it's really depends on where you live. So in a higher cost state like New York, I always love to use them as my examples because it has a bigger impact there. You have your single filer $100,000 that puts you in the 24% federal tax. Then you save your FICA tax because you don't have to pay that Social Security Medicare. You're doing paycheck deductions, and then 6.49% for the state of New York. So every dollar you put in there, you know, is worth 62 cents of tax savings. And then if you decided you wanted to, you can spend the HSA dollars today for your healthcare costs, or you can use it as an investment account to fund future healthcare costs.
That's
So
massive
yeah,
tax
it
savings.
can be, and I really hate taxes because it's like such a hidden cost that I have a lot of people, especially with financial advisors, do a lot of tax planning. They don't give tax advice, but they do tax planning. And I see this tax planning that's saving clients like more than $25,000 a year, but it doesn't print on your statement. You don't really see the value printed anywhere, but it really is a big impact. So paying attention to taxes can really help our situation over time.
Do you think people factor that in when they're deciding whether or not to choose the high deductible health plan HSA combo, the tax
Never.
savings part of it? Yeah.
I typically never see people actually computing how much would I be saving on taxes, and let's add that in as a cost. Um, People usually, you know, around tax time, they get like a big refund or they have to pay in and there's some grumbling, but they don't think about it throughout the year. It's just this one time event. So I typically don't see people look at that as they're evaluating what to do.
They're just looking at the premium amounts and
Yep.
potential deductibles and the contribution from the company.
Yep. Exactly. So what we really like about HSA is that triple tax advantage, that it's portable. So you own this money. It's an investment account, just like your IRA. You can take it with you and roll it over if you leave your firm. The other thing that we didn't discuss yet is if you let the money grow in your HSA over time, you are not going to be subject to required minimum distributions like your traditional IRA, like your pre tax employer plan. Once you turn 65, you can take the money out of your HSA and it doesn't have to be a medical expense. The downside of that is you would pay taxes on it just like a traditional IRA. So you're losing some of the tax advantages, but these become fully flexible at 65. That, hey, you have the choice. Do you want to use it like it's a traditional IRA and pay the tax bill and buy that Maserati you want? Or do you want to use it for your medical costs, your dental expenses, and take that money out tax free, just like you're pulling money out of a Roth IRA? So they're really designed to give you a lot of flexibility in retirement once you're 65. But let's say you have $100,000 in your HSA and you're under 65 and you say, oh, I'm going to go and use some of that money to buy that Maserati. You pull the money out and there's a 20% penalty if it's not a qualified medical expense. So keep in mind that flexibility opens at age 65 to avoid a penalty. And the other thing people love about HSA is it's not limited by your income. When we look at things like, can I contribute directly to a Roth IRA? Oh, your income's too high. There's a lot of income phase outs for programs. This one is not limited by your income. So people that are retired and they retired before they're Medicare eligible, they might say, hey, I'm going to get an HSA qualified high deductible health plan so I can get some tax savings while I'm retired.
Julia, why do you think the penalty age is 65 and not 59 and a half like it is with most other retirement plans?
So with
Most
this one,
retirement plans.
I believe they're lining it up more with Medicare eligibility. Hey, we're going to design this as a health savings account. And then once you turn 65, you're eligible for Medicare and you can use your HSA dollars to pay for your Medicare premiums. If you want to reimburse yourselves for those Part B premiums once, twice a year, monthly, we're going to let you do that. But hey, we're going to make this more flexible and we'll say, hey, you've made it to the goal line. You're now eligible for Medicare. You can use it for whatever you want. So I think they just aligned it because Medicare is 65 and that's the federal government health plan. Let's align HSAs to that.
And did you say it
Kind
was
of
a 20% penalty?
it is for under taking distributions when you're under 65 and it's not a qualified medical expense. So we
So,
do want to make sure not
yeah,
to take money out before 65 for anything that is not healthcare related.
because you get taxed on it as well as the 20% penalty.
Yes.
Okay.
Yep. So we definitely don't want to do that. Something to be aware of. So one thing when we're talking about HSAs and getting that tax-free distribution, which is the goal for a lot of us, that's what we want. Keep in mind, if let's say, we're getting towards open enrollment and you had that traditional like PPO plan and you had a big bill earlier this year, it was $1,000. And then you go through open enrollment, you pick up the high deductible health plan and you open your HSA, you know, January of next year. Well, you can't reimburse yourself for this expense you had earlier this year because the HSA wasn't established. But let's say in January, you open your HSA and then you get $1,000 bill the end of January, but your HSA only has $50 in it. You're like, darn, I can't reimburse myself. The money's not there. Well, a couple years past, you've been saving in your HSA and you've had some great investment returns and the money has grown. Well, now years in the future, you can say, oh, that expense happened after I opened the HSA. I'm going to reimburse myself now. So even though the money wasn't in the HSA at the time, the HSA was still open. So as long as the expense happened after the HSA was established, you can do that reimbursement later in life, even years down the road.
What if you've gone from HSA to PPO and then back to HSA? Does it have
So
to be while you're using a high deductible health plan, the
so you
expense?
so you are able to use it to, like for example, you're retired, you're on Medicare, it's not a high deductible health plan. You can't put any more money in it, but you can still reimburse yourself for qualified medical expenses. So you still are allowed to use it to do those reimbursements as long as the expense happened after that HSA was in place.
And how do you recommend people keep track of these expenses over time that could potentially accumulate if they want to get some investment return and leave the money in the health savings account and then take it all out at once later on?
So if you can do something digitally, it always usually works best because sometimes we're talking 10, 20 years. So some people they'll have a marker. They'll say for any expense that's over $100, I'm going to just scan that receipt, throw it into my file, and I'm going to keep it digitally on my computer and make sure I have that folder for all of my tracking of my medical expenses. And then later in life, you can take a bunch of those expenses and get a bigger tax-free distribution when you're retired. So if you can do it digitally, that's always the best. Um, I'm not the greatest with digital myself, so you can keep paper files in a fireproof box if you want. And then when it comes time, but now you have all these papers and you want to make sure they don't burn in a fire. So we do want to have like a fireproof box, and some people will keep them paper version. The the other thing that I want you to recognize is the government doesn't want us to double dip in tax advantages. So there is something right now for people that are itemizing on our tax returns. Hey, you're not taking the standard deduction, you're itemizing. Keep in mind, if you are itemizing, and there's something that you can itemize called the unreimbursed medical dental expenses if it exceeds 7.5% of your AGI. They'll say, hey, you can't go and pay for this with HSA money and then go and take another tax advantage and itemize that. So something to keep in mind, especially when we say, hey, some people use their HSAs to plan for long-term care expenses. So this is for people that you need help with the activities of daily living. You need help getting out of a chair, going to the bathroom, things like that. You're not covered by your health plan. You're not covered by Medicare. You can use your HSA dollars as a qualified expense to pay for the premiums for your long-term care insurance. Some people will use it to pay for their long-term care. Hey, I'm in assisted living. I'm going to pay that big bill tax-free. Other people will say, hey, I'm not going to use my HSA dollars to do that. I'm going to take that unreimbursed medical dental expenses and I'm going to take that and itemize instead of using HSA dollars for it. You can't double dip. Good to talk to a tax professional to decide what's best for your situation. Then also for people that are unemployed and you go on COBRA. And COBRA, what that means is, hey, I got laid off or hey, I retired and they're going to let me continue with the coverage I had through my employer. Same coverage continues as is. COBRA premiums get pretty expensive, but they will let you use your HSA to pay for those premiums or pay for some insurance premiums if you are getting unemployment income. So if you're unemployed, they give you a pass there. Otherwise, if you're not unemployed, you cannot use your HSA dollars to pay your premiums. So you have your biweekly premiums. You can't reimburse yourself tax-free for that. It's only if you are unemployed. Then what a lot of people do is they say, hey, I want to fund my healthcare costs in retirement. So what I'm going to do is most people don't have to pay for Medicare Part A, that's your hospital coverage. Part B comes with the cost. Like this year, the minimum anybody's paying is $185 a month. And then Part C is Medicare Advantage. There's out-of-pocket costs, co-pays. You might have to pay $400 for an MRI. Part D is your drug plans. Hey, I have to pay for some of my prescription meds out of pocket. You can reimburse yourself for these costs. So some people, they do it on a schedule. Hey, every quarter, I'm going to do a big reimbursement and get this tax-free income to cover these costs. Helps, especially if you're taking required minimum distributions that are making your income higher than you want. This gives you some extra income without having a higher tax bill.
Julie, is that
So
still true if the Part B premium is being withheld from Social Security?
So they force you to pay your Part B premium out of your Social Security check. So what most people do here is they take their Social Security statement, which outlines your Medicare Part B premiums, and then submit it for reimbursement, that they just throw the money in your checking account. So there's no way to just have it cover Part B. You have to do a reimbursement. So most people will not want to deal with the hassle. They'll do it every 6 months or once a year just to get that big tax-free reimbursement. The thing that is annoying is Medigap. That is for people that say, hey, I want to, with Medicare, it doesn't cover all of your out-of-pocket costs. You can buy a Medigap policy to cover those out-of-pocket costs, and you're buying that from a private insurer. Well, they consider that private health insurance, that they won't let you cover those premiums as a tax-free distribution. Hopefully they change that in the future at some point, but as of today, that's why I call it out here. You can use it for most of your Medicare costs, but not for Medigap plan premiums. And then for us that are younger, that we're not using this to save for our future healthcare costs, we might be using it for prescription, vision, dental expenses, our deductibles, copay, coinsurance. So let's say you decide, I'm going to pay for my daughter's braces today, and it's $4,000. And I got this big bill, and I have the money to pay for it. I'm working full time. I'll just pay the $4,000 out of pocket. I'm going to leave the $4,000 in the HSA. 10 years later, oh, my kid's in college. I need a little bit extra. Oh, I'm going to take that $4,000 receipt. I'm going to submit it 10 years later to get that tax-free reimbursement. And that $4,000 has now grown to $8,000, and I made out. So keep in mind, they call that shoeboxing your receipts. I'm going to shoebox them away to use in the future.
Do you actually have to submit a claim to the HSA, or it's an honor system? You can just take a distribution, or does it depend on the custodian?
So most of the custodians are going to have you submit a receipt that you're going to have the image, and you're going to say, oh, here, I'm getting reimbursed. Here's my receipt with the amount. Is typically they'll ask you to do that. Kind of like when you have a we have this benefit that they just put in place at Vanguard. It's for your well-being. You can use it for lawn services. I have to go and say, oh, I had a landscaper mow my lawn. Here's the receipt. They give you the money back. It's kind of the same kind of deal. It's funny, all these
Is that
embedded,
real?
oh yeah, this is real. They just they there's these it's becoming a more popular benefit. They call it like a well-being benefit. Sometimes they call it like flex funds. A lot of employers are starting to do this, and you can use it for something that's going to help your well-being. Maybe you want to get a meal service. You want to pay for someone to mow your lawn. You want to buy an iPad that's going to help with your well-being. It's cool. It's like a couple $1,000, but I like it as a benefit.
I'd love to see the list of qualified expenses on that program.
Yeah, you could use it for camp for your kids. Oh, over the summer, I'm going to want to send my kids to camp. That's helping with my well-being. It's a big, long list. Yeah,
That's
they're
fantastic.
becoming
Are you
more
using the
popular.
lawn thing?
I do it for my husband has decided he's no longer mowing our lawn, so I've been paying someone to mow our lawn. Yes.
Was that because he wasn't good at it, or he didn't have the time?
Um, it he's just meticulous. So he would spend 5 hours and then he'd have a 3 hour prep time to complain about starting the five. So it would be 8 hours every weekend. And it just was too much complaining.
Yeah.
He was good at it. It just was, he took too long and there was a lot of complaining and then it ruined every weekend. So
Ryan
it's
said he,
worth the
he
cost.
Ryan said he used it for golf clubs.
God, yes, for his well-being for golf clubs.
That sounds like you could pretty much use it for anything as long as you can say it's for your well-being.
Yes. So not an HSA. This is the flex fund.
All
Yeah.
right.
So with HSAs, a lot of people they have the ability to have an HSA, but they don't contribute to it. And then many people do not contribute the max. They contribute way below the max. And a lot of people have it sit in cash. You will have investment options, and cash will be one of them. Hey, have it sit in a money market. But if you can put some money to work, sit down with your advisor on like, how should I invest this? You can get a lot of growth on this versus having it just sit in cash and maybe not keep up with inflation. So a lot of people don't know how to use it. So at Vanguard, we say, here's how we would think about like investing our next dollar. Never give up a match. So if your employer is saying, hey, we're going to match you up to 4% in your employer plan, don't give up that free money. But number two, you might want to think about like, how much do I want to put in my HSA? We're going to have healthcare costs. I can use it for my healthcare costs or save it for my future healthcare costs, which I will have. Medicare is not free, it's expensive for a lot of people. Then we'll think about those other tax advantaged accounts. Hey, my Roth IRA, I have a traditional IRA, I can put more into my employer plan until I max that out. Do I want to do 529? Do I want to save for college that way? And then taxable accounts last. So the three common things I see when it comes to HSAs, number one, let's use it as an emergency fund. Hey, I'm really healthy right now. I'm not going to the doctor a lot. I'm going to take whatever my employer is willing to give to me. I'm going to put as much as I can into the HSA. And then, oh, I need to get a surgery. Something happens unexpected in the future. I can use that. If I can afford the bill at the time it comes, I'm going to pay it, save the receipt, and then reimburse myself in the future. The most common use case I see, well, I shouldn't say most common. I do see a lot of people spending their HSA money year over year. Hey, things come up. You're like, I don't really have the funds right now. I'm going to spend it. And at least it's going to be tax free. But a very common use case is to use it for retirement. Hey, I am going to use this when I retire. I'm 65, I go on Medicare. I really want to wait until at least age 67, maybe age 68 to turn on my Social Security and get that additional income. All those receipts that I saved over the years, I'm going to go and reimburse myself at age 65, 66, 67 to give me that income I would have gotten from Social Security to give me a couple more years to delay and get a higher payout. And then also, some people look at this as a long term care insurance, like, hey, I'm going to self insure, stockpile money over here, and I'm going to use that to pay for my long term care expenses. Something to think about, we do want to spend our HSA dollars. When we transition from accumulation to decumulation, it really twists our mind. We're like, I'm not supposed to spend my money. Don't spend. It really takes a lot to shift to like, wait, this is what I was saving for. Now it's time to spend. When we pass away, our HSA goes to our spouse if we have one, and they can use it as an HSA. So that's great. But when it goes to that non-spouse beneficiary, now it's not an HSA anymore, and there's going to be a tax bill. So ideally, we want to go and use all of our HSA money and spend all of it before you and your spouse both pass away to get the full tax advantage. So HSA is really flexible. You know, you can really get a lot to help for your healthcare needs today and in the future. And there's one more, and we can also, we have a brochure that we can have sent out to you that has this case study in it. But what I see a lot of people, they look and they say, okay, and I actually copied this from a real person. This was their choices in open enrollment. I have the option of a PPO and a high deductible health plan. So I have two options to go in. If I go with the high deductible health plan, I'm going to have access to a health savings account. And my employer is giving me $2,000 if I go this direction. So that's what we're looking at here. Well, what we want to evaluate is premiums. For the PPO, this person would pay $500 biweekly. If they went with the high deductible health plan, it was $250 biweekly. So a big savings here. But this family was a family of four, and they're like, I have two kids. We have high healthcare needs. We go to the doctor 36 times a year. We go to urgent care once a month, and we go to a specialist 6 times a year, looking at their healthcare from last year. That's high healthcare. I don't want to pay a $5,300 deductible. That's way too much. So in their head, they were only looking at the deductible for their decision. And every year they'd been going with the PPO, which also came with a $1,500 deductible, but that felt more reasonable than $5,300 for this particular client. Well, when you do the math and you crunch it all out, keeping in mind preventative visits are 100% covered usually on both plans. Every plan sets a max out of pocket limit. So we want to know what's the family max, what's the per person max, because maybe one person in the family is sick, but everybody else is pretty healthy, and you might only max out for that one person. So we want to take that all into account. This was just a typical family of four with two kids going to the doctor all the time for little things here and there. Nothing catastrophic. Nobody was having a baby. Nobody had cancer. When you run through the numbers of what we're paying for the premiums and our out-of-pocket costs, knowing that the PPO has a copay for the visits when you go to the specialist, when you go to the doctor. When you look at the end of the day, the high deductible health plan, they had to pay out of pocket. They met their deductible. And then they had a 20% coinsurance where they had to pay a little bit more out of pocket. When you account for the $2,000 they were getting from their company and the tax savings they got, their $2,000 from the company plus the $6,000 that they were able to put in because their premiums were much lower, they were able to afford to take that extra that they would have been spending 500, they put an extra 6,000 in the HSA. That meant $8,000 a year they put in the HSA, which came out to over 3,400 in annual tax savings. They were in Pennsylvania. They were in the 32% marginal federal tax rate. Well, nobody usually takes that into account, but when you actually take that into account, you can see for this family, the high deductible health plan was a much lower cost plan than the PPO all in, even with that high deductible. The
Not
family
even
was
close.
able to, yeah, it was pretty amazing. Once we let that money ride and we look out 20 years, they could fully fund their healthcare costs in retirement with half of that being investment earnings. So I know, John, can you mention something about, you were telling me that you have a tool that you actually can help clients run through this math.
We do. We have access to an app called Healthy Hive that does a lot of what you just did on the screen there, but we plug in the information that you mentioned and it just does the analysis for us. So when we're doing it for clients that have questions about whether or not they should use their high deductible health savings or health plan with the HSA, we go through that analysis for them because
Yeah,
I think it differs drastically between employers. Like sometimes you
it
see that
does.
type of situation, sometimes you see the opposite, sometimes it's sort of a wash and you're just like, well, what makes you feel more comfortable? Do you want to have the knowledge that you have a low deductible and everything's going to be pretty much covered, or do you want to take more advantage of tax savings and
Yep.
be okay with paying the out-of-pocket expenses as they come along?
Yeah, the other thing, if you were to come to me and say, "Hey, my wife's pregnant, we're having a baby next year, and I have a really aggressive cancer, I'm getting cancer treatments all year." What becomes very important is the max out of pocket limits. Hey, you're probably going to max out for both people. And then that year, you might opt into, I'm going to do the PPO because we're certainly going to hit our max out of pocket for the family, and it's much lower than that high deductible health plan. And maybe we'll have access to a flexible spending account where we can get some tax advantages doing the FSA plus the PPO. So want to reinforce it's not always high deductible health plan with an HSA. It's really like, what are your healthcare needs for this upcoming year? What are your costs? Let's look at it side by side and consider the tax advantages.
Yeah, and for younger people that are single and don't have children, I think they'd be crazy not to do the health savings account because
Yep.
of not only the tax benefits, but also in most cases they're not going to be spending anything, so their premiums should be lower and out-of-pocket costs should be lower.
Yep. And then when if they later in life, hey, they go get married, have a couple kids, they already have that big nest egg, and then that big braces bill comes. You're like, oh, look
Yeah.
at this. I'm shocked at what braces are costing these days.
What are they in your area?
I so I always would like my one of my best friends, her kids are just going through braces. I'm like, oh yeah, it's like, $2,000, right? She's like, no, it's more like 6 to 8,000.
That was yeah, had them, 30 years ago, so I was like thinking, oh, it's going to be the same, $2,500, but no, it's more like I think it was 5,700.
Yeah, like yeah, 6 to 8 is what I'm seeing. It's shocking.
And
So
at least in our area, it doesn't help to price shop because it's like a cartel. They've
yeah,
all the orthodontists have gotten together and fixed the prices of braces
yeah,
in the region, so it doesn't help to shop around.
yes.
Anyway, well, you mentioned I was looking at one of the slides and you mentioned that only 13% of owners invested some portion of the accumulated money in the HSA. Why do you think that
Mhm.
is? Do you think it's because they don't know they can? The investment options aren't good. There's not enough money in there to make it worth it.
I think it's just not paying attention. That's my opinion is if you don't actually select investment options, they're going to default you into the most conservative cash. And then you get dumped into the cash account. And I'm thinking of my cousin here. She was contributing to a Roth IRA and she was doing it. She's like, oh, I'm putting the money in the Roth. But then she was doing it herself, not working with her advisor. And for 10 years she had not invested any of that money. It was sitting in a
Just
cash account.
waiting.
She thought she was investing it because she just put it in. She's like, well, I put it in. I think that's how people think about HSAs. Well, it came out of my paycheck and it went into my HSA, but they didn't take that extra step to select their investment options to invest the money. And it's defaulting to a very conservative cash type of account with low returns.
Because in most cases, you have to move it from like the cash side to the investment side manually. It doesn't just do that automatically.
Yes,
Is that right?
yeah, you'd have to, yeah, so, like select it. You can have it like automatically invest depending
Oh,
on
you
your
can. Okay.
company. Depending on your company and how they have it set up, what HSA custodian they have, you can have it go directly in, but some people just miss that step. And there are some HSA providers out there. I see this in the Midwest a lot where they actually like they only allow you to have a cash account. Like that's their only option. Well, you can move the HSA dollars to a custodian that allows you to invest in, a wider range of investments.
While you're still working there, or do you have to be separated from the company?
You can still transition it out. You can
Oh, okay.
poured it out to invest. I'm seeing that less common now. Like years ago, it was common. I'm like, that's the only option they have, cash. But I think it was still new and it's evolving and they're getting bigger, or firms are saying, hey, I'm gonna pick a bigger HSA provider because I'm getting better pricing on it and I can give more options to my employees.
Does Vanguard have a health savings account, like independent option for people?
We do not. So we don't offer an HSA directly. It is a lot of, let's say, administrative work. So these HSA providers, it's typically all they do is HSA claims. And also we work closely with Health Equity. They have really great pricing structures and they have good investment options. They have it, I guess it for us, it helps. They have Vanguard as some of their investment options. So we like that too.
Yeah, I would think you would limit it to Vanguard funds within the
Yes.
health
Yes.
equity HSA, at least for your employees.
Yeah. They tend to have a lot of, tried and true. Let's do like, index fund investing, something, hey, you can do all equity if you want, but they have a lot of index options.
When you guys have open enrollment, do you like walk around Vanguard with a sign, t telling people to max out
Va-
their HSAs?
Vanguard actually does a pretty good job of sending out like little blitzes, like, hey, understand this benefit, understand this. But
That's good.
yeah.
Great. Well, thank you so much for your time today. This was awesome. And, I think, like you said, it's a very powerful tool and people that have access to it should be taking advantage of it when they can.
And one thing I didn't mention, and I think it's pretty important, I think I didn't mention it. So a lot of people retire early and go on the Affordable Care Act. They now made every single bronze plan HSA qualified, meaning if you're somebody that's going to go to the Affordable Care Act to purchase your insurance prior to you going on Medicare, which a lot of people do, if you choose one of those HSA qualified funds, you contribute the family maximum, which you can get like close to $10,000. That's going to reduce the income on your tax return. So by you contributing to an HSA, your AGI gets lower. And the reason why that's important is you get better pricing in a lot of situations. If you can keep your income low, you qualify for lower premiums. So some people use this as a tactic to lower their healthcare premiums when they're going to be an early retiree. Let me go. I'm not working, but I can contribute to an HSA, lower my income. And then if I want to go and use that money to pay for my healthcare expenses, I can. But this could help me qualify for premium tax credits to lower my monthly premiums. So, one thing that's important for early retirees.
Yeah, that's a great point. Yeah, we didn't talk any about the one big beautiful bill, and I know the House version had a lot of proposals that
And
affected HSAs, but the final version didn't have much. One
yeah,
one thing,
The Senate struck down a lot of
yeah,
it, which was a little disappointing. They basically the big thing that came out of it was really, hey, Affordable Care Act, we're going to make like all of the bronze funds HSA qualified. So we're going to have a lot more, you know, plans that you can get an HSA.
which is huge.
Yeah.
And they also allowed concierge medicine, like monthly fees to be considered eligible medical expenses, I believe. Was that part of it?
Yeah, I don't think that one made it into the bill. They were doing more telehealth, made it in. They stripped a lot of the fun things from it. So it's wasn't like big news on the HSA front.
Yeah, I think wasn't like gym, like health club fees were
That
reimbursed
that
and
was in
like
the House version and then didn't make it through the
plastic
Senate.
surgery and
Yeah. Yeah.
sorts of things.
The Senate didn't like a lot of it. They stripped it out. The one thing that in the House version, they were saying, hey, you sign up for Medicare Part A, we're going to allow you to still contribute to your HSA if you're still working.
Right, right.
Senate didn't like it, stripped it from the bill. So they stripped most of it out, and it was bare bones at the end with the HSA changes.
Yeah, cost cutting. I, a lot of those probably would have resulted in additional costs.
Yeah.
All right, well, thanks, Julia.
Thank you so much. Have a great rest of
Appreciate
your
it.
week.
All right, you too. Take care.
Thank you.